EPK Capital presents Deep Dive on Coal India. Hello everyone, welcome to EPK Capital's Deep Dive video. I am your host, Rutvik. In this series, we analyze one company each day based on the security analysis by Benjamin Graham. Today we are going to talk about Coal India. The story of Coal India is one of a profound paradox. On one hand, it is a colossus of the Indian economy, a Maharatna public sector enterprise, the single largest coal producer in the world, and one of the largest corporate employers globally. It is an indispensable pillar of India's energy security, contributing to 80% of domestic coal production and meeting 40% of the country's primary commercial energy requirements. On the other hand, it operates at the heart of an industry facing immense global and domestic pressure to transition to cleaner energy sources. This dual nature, being a vital strategic asset while facing an existential long-term threat, is what makes this stock a source of deep fascination and heated debate. The Colossus of Coal. Company profile and history. Coal India Limited, or CIL, is a state-owned coal mining corporation that came into being in November 1975, following the nationalization of the coal sector. From its modest inception, with a production of 79 million tons, MT, CIL has grown to become the world's single largest coal producer. Its scale is monumental, operating in 85 mining areas spread across 8 Indian states and managing a total of 310 working mines, including underground, open cast, and mixed mines. As of April 1, 2025, the company was also one of the largest corporate employers, with a workforce of over 220,000 people. Beyond its sheer size, CIL's strategic relevance to India's energy infrastructure is unmatched. It supplies a massive 55% of the country's total power generation and plays a key role in national initiatives like Make in India. The identity of a company's promoter is a critical factor in understanding its investment thesis, and CIL's promoter is unique. The company is a Maharatna enterprise, a privileged status conferred by the Government of India to empower select state-owned businesses to expand and become global giants. This exclusive club consists of only 10 members out of more than 300 central public sector enterprises, CPSEs. This status provides CIL with a powerful backing from the state, effectively granting it a quasi-monopolistic position and a captive market. The Government of India, through the Ministry of Coal, is the main promoter, holding a significant 63.13% stake in the company. This strong ownership structure provides a massive foundation of stability and a vested interest in its success, given the company's crucial role in energy security and its contribution to the government exchequer. CIL. However, the nature of CIL's ownership is a double-edged sword. While it provides a protective shield of state support, it also means that the company's operations are not driven solely by a pure profit motive. CIL must balance commercial viability with social obligations, such as managing employment and ensuring fair rehabilitation and resettlement for communities displaced by its mining operations. Furthermore, its dominant position is not beyond legal challenge. A significant Supreme Court ruling in 2023 determined that CIL and other state monopolies are, in fact, subject to the Competition Act 2002. 9. The court clarified that carrying on a business in mining cannot be considered a sovereign function, a legal determination that fundamentally alters the company's operating environment. This judgment introduces a new dimension of regulatory risk, as CIL's actions can now be challenged by the Competition Commission of India, CCI, on grounds of unfair or discriminatory practices. The company's relationship with its promoter, therefore, provides both a source of immense strength and a layer of inherent political and regulatory complexity. A decade in the black, the financials. While the stock chart may show periods of volatility, a deep dive into Coal India's underlying financials reveals a story of consistent profitability and financial prudence. Over the past decade, the company has proven to be a financial fortress, characterized by high profitability, minimal debt, and a generous dividend policy. In FY 2016, CIL first surpassed the Rs1 lakh crore mark in gross sales, cementing its position as a financial powerhouse. In the fiscal year ending March 31, 2025, its annual revenue stood at $1.33 trillion. For the last 12 months, the company recorded a revenue of $1.26 trillion. The company's profitability metrics are particularly impressive. As of the latest available data, CIL boasts a high return on equity, ROE, of 38.9%, and a return on capital employed, ROCE, of 48.0%. These figures are well above the industry median, indicating a strong ability to generate returns for its shareholders and effectively use its capital. The company has also maintained healthy net profit margins of 26.4%. A major attraction for investors is CIL's consistently high dividend yield, which has ranged from 6.77% to 8.47% in recent periods. This makes it a compelling choice for income-oriented investors seeking a stable stream of passive income. The company's balance sheet further reinforces its financial stability. CIL is considered an almost debt-free company with a remarkably low debt-to-equity ratio, ranging from just 9.15% down to 0.09%. As of March 2025, while its gross debt had increased to Rs 91.5 billion, the company's cash reserves of Rs 373.9 billion resulted in a substantial net cash position of Rs 282.4 billion. This strong financial position provides a significant buffer to weather market fluctuations and fund future strategic projects. However, a closer look at a less discussed metric, free cash flow, FCF, reveals a potential area of concern. Over the last 3 years, CIL's free cash flow as a percentage of its earnings before interest and tax, EBIT, was only 32%. This is considered a weak conversion rate. A company's ability to convert its accounting profits into tangible cash is a critical indicator of its financial health. The weak FCF conversion may explain some of the market's skepticism, as it suggests that despite high-profile profitability, the cash is not being generated and returned to the business or its shareholders as efficiently as one might expect. The juxtaposition of CIL's robust fundamental metrics, high profitability, low debt, and generous dividends, with its recent stock price trend, illustrates a clear disconnect. While the company is fundamentally sound, its market performance appears to be influenced by factors beyond its balance sheet and income statement. The market is not pricing the stock based on its current tangible strengths, but rather is applying a discount for the long-term, future-oriented risks associated with the coal industry. The company's weak FCF conversion provides a tangible financial reason for this market behavior, as it signals a hidden inefficiency that undermines its otherwise stellar financial profile. Graham's lens: is Coal India a value stock? To assess whether Coal India is a potential value investment, we can apply a classic valuation method proposed by Benjamin Graham, the father of value investing. Graham's approach focuses on finding a margin of safety by buying stocks at a price significantly below their intrinsic value, as determined by their earnings and assets. A simplified version of his formula, often referred to as the Graham number, is used to estimate this intrinsic value. The Graham number is calculated using the following formula: V 22.5 x EP x BVPS. Applying the formula, we get V 22.5 x 53.7 816 A81194 570 62 Rs 441.1. Based on this conservative valuation, the calculated intrinsic value of Rs 441 is notably higher than the stock's current market price, which has been hovering around the Rs 380-390 range. This suggests that, from a traditional value investing perspective, a margin of safety exists, as the market is pricing the stock at a discount to its estimated intrinsic value. However, it is crucial to recognize the limitations of this model for a company like CIL. The Graham number assumes stable earnings and book value and, most importantly, does not account for qualitative factors, long-term growth potential, or significant industry-wide risks. The fact that the stock trades at a discount to its Graham number is a powerful statement about the market's perception of risk. The market is not pricing the stock based on its current solid fundamentals. Instead, the discount reflects a risk premium for factors that lie outside the scope of the formula, such as the long-term viability of the coal industry and potential policy shifts. The stock is undervalued only if an investor is willing to accept these long-term risks. The two sides of the coin, bull versus bear case. The investment case for Coal India is a direct reflection of its paradoxical nature. The bullish and bearish arguments stand in stark contrast, each with compelling points. The primary argument for the bull case is rooted in CIL's strategic importance to the Indian economy. India is a fast-growing nation with immense and rising energy demands. Despite a strong push for renewables, the government continues to rely on coal as a bridge fuel. The Ministry of Power has even announced plans to add 90 GW of new coal-fired capacity through 2032, and CIL itself has set a production target of 875 million tons for FY 2026, which highlights coal's undeniable role in meeting the country's baseload power requirements for the foreseeable future. From a financial perspective, CIL is a rock-solid company. Its high profitability, strong balance sheet, and a debt-to-equity ratio of less than 10% provide a robust foundation for weathering market volatility. For income-focused investors, the consistently high dividend yield, which is far greater than the industry median, makes the stock an attractive source of passive income. Furthermore, recent government policy actions, such as the removal of a R400 per ton compensation cess and an increase in GST on coal, are expected to lower the delivered cost of coal for most domestic users, making it a more attractive fuel source compared to imported coal and potentially boosting CIL's domestic market. Finally, CIL is not static. It is actively diversifying by issuing tenders for $5 GW of solar and wind projects, signaling a strategic move to adapt to the energy transition. The bear case centers on one undeniable long-term threat: the global push to decarbonize. While coal will remain a primary energy source in India for now, its share in the energy mix is projected to decline from 70% to around 50% by 2030. The long-term risk of its assets becoming stranded in a world shifting to renewables cannot be ignored. Regulatory and legal risks also pose significant challenges. While government policy is a bull case tailwind, any shift in that policy, such as the reinstatement of a cess or the imposition of new, stricter environmental norms, like those for sulfur dioxide emissions, which were recently reversed for many plants, could severely impact the company's profitability and operations. The Supreme Court's ruling that CIL is subject to competition law is another ongoing risk, as it challenges its dominant position and holds it accountable for fair market practices. Operationally, the company has shown a recent decline in production, with output dropping by 3.5% in the April-August period of the current financial year. This, coupled with the previously discussed weak conversion of EBIT to free cash flow, presents a clear financial red flag. Lastly, the Coalgate scandal, while a controversy over government policy rather than direct CIL management, has created a major reputational stain on the entire sector, which could affect investor sentiment and raise concerns about transparency and governance. Final thoughts: a strategic imperative. Coal India is a company defined by its contradictions. It is a fundamentally strong, high-dividend stock that, based on a conservative Benjamin Graham valuation, appears to be trading at a discount. It is a strategic national asset with an almost guaranteed market in the medium term, backed by government policy and a robust balance sheet. However, this is not a traditional growth stock. The investment thesis is a complex one, deeply intertwined with India's evolving energy policy and the global push for a cleaner future. The stock's current valuation reflects a delicate balance of these forces. The market is applying a risk premium for the long-term existential threats, while recognizing the company's current financial strength and strategic importance. Ultimately, investing in Coal India is not for everyone. It is a play on India's long-term energy needs and a belief that the transition to renewables will be a gradual, phased process rather than a sudden, abrupt shift. It is a stock for the discerning investor who understands this unique blend of fundamental stability and long-term regulatory and environmental risk. This is a strategic bet, not a speculative one. This report is for educational and analytical purposes only and does not constitute financial advice. The information is based on publicly available data and professional analysis. Investment in stocks and other securities is subject to market risk. Past performance is not an indicator of future returns. Readers should conduct their own due diligence and consult a qualified financial advisor before making any investment decisions. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next.